Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So, three insets, 5 minutes. Let's get started. So, the stock market's recovery is slightly better than history when we take a look at S&P 500's performance going back to 1950. Number two, stable but slowing labor market trends over the past week. A lot of jobs data out recently. And then finally, market sentiment in terms of bearish or bullish, extreme bearish sentiment during April. That is no longer at a bearish extreme. Let's talk about the implications of what that's telling us. So this is a chart of the S&P 500's performance following a 20% correction since 1950. If you recall, at the April bottom, the market did not quite reach that threshold of 20%. In fact, it was only down 19%, but very close to that typical classic bear market threshold of 20%. So looking historically, after the market has corrected 20%, during the first 40 days after that bottom, the S&P 500 on average is up 13.8%. The median recovery after that bear market drawdown is 12.5%. This time's a little bit faster. The 2025 rebound off its lows is progressing at a slightly faster pace of 17.3%, but largely a very similar trajectory in terms of rebounding price action of what we've seen historically after major market drawdowns. Now, lots of jobs data out over the past week. We had on Wednesday 1st the ADP payrolls report that showed 37,000 private sector jobs added. That was the lowest in just over 2 years. That was followed Thursday by the weekly jobless claims that came in at 247,000. That's what's shown on the chart here. That's the highest number of jobless claims since back in October of 2024. Not too far off from expectations. We obviously got the monthly jobs report out on Friday as well. When we look at the unemployment rate holding steady at 4.2%, you have job openings from the JOLT survey also at 7.4 million. That is off of its peak, obviously, in over the past year, but it is still relatively elevated, and there's still a lot of jobs out there right now. So when you unpack the weight of the evidence for the labor market, I would categorize it as stable, but perhaps some slowing of labor market trends over the past couple months. Now, market sentiment has come well off its bearish extreme. On the chart, we have the AAII percent bearish. AAII is a sentiment poll where they ask their members each and every week, are you bearish, bullish, or neutral on the stock market over the next 6 months? And here is a chart of the percent that answered bearish. And you can see it peaked in April at 61.9%. That was one of the highest that it's had in history, and that was the highest since March of 2009, which was the bottom of the financial crisis. And it actually stayed elevated above 55% for 6 weeks. Now, bearish sentiment, as you see, has come down significantly, so it's no longer at an extreme like we typically see around market bottoms, but it's not necessarily optimistic just yet. If you look at the long-term average bearish percentage for this indicator, going back all the way to 1978, it averages 30.5%. At 41, nearly 42%. Investors are still pretty cautious. And if I had to speculate as to why, I think it's a combination of concerns of the uncertainty of tariffs, inflation, and a potential economic slowdown. So, speaking of tariffs, some pretty good news around the Trump China negotiations, if you will. They've been at a stalemate where Trump was getting very frustrated that he could not have a conversation with President Xi. That finally happened. The two men got on the phone for a 90-minute conversation. Word from that conversation is that overall it was very positive. They talked about critical minerals and some of the other areas that China had concerns about. Went somewhat well because we actually saw both presidents extend invitations to the others for a physical in-person meeting at China and U.S. respectively. Both presidents also quickly accepted. So hopefully this means negotiations and discussions are trending in the right direction. Remember, this was the big relationship that was really rocky that started a lot of this, in addition to Canada, Mexico, during this tariff situation. So to the extent we can get an improvement in China and U.S. relations, especially for the amount of imports that the U.S. currently takes in from China, that will be better for the overall stock market. And I think that's what the market is pricing in, is a somewhat positive resolution to the tariff talks with the strong rally that we've already had off that bottom. With that, I want to thank everyone for watching. Hope everybody has a great weekend, and I'll see you next time.